stop. If your mortgage renewal is coming up in 2025 or 2026, the worst mistake you can make is simply shopping around to get the best interest rate. Yes, you heard that right. And to be clear, this isn't another rate shopping video. We're focusing on a very dangerous trap. Why? Because a massive wave of mortgage renewals is coming in 2025 and 2026, and it's bringing financial challenges that no interest rate alone can solve. Today, we're going to show you why just chasing that low interest rate is not enough, and building a long-term financial plan can help save you your home and your wallet. In the next few minutes, we'll aim to arm you with a strategic game plan for your upcoming mortgage renewal. We're talking about restructuring your finances beyond the interest rate. This is so you can weather whatever storm the economy throws at you. This is going to be serious data-driven insights that every homeowner needs to hear. Let's dive in. So remember the talk of a mortgage renewal epidemic? Some headlines last year and this year have said there's going to be a tsunami of mortgage defaults due to all the renewals coming up at much higher rates. Well, lucky enough, the Bank of Canada may have just averted the worst case scenario by cutting rates over the last year. Pretty much canceled this so-called epidemic by interest rates falling a near 2% on a national scale. Interest rates have fallen nearly 2% in 2024, easing lots of pressure on millions of borrowers. Sounds like good news, right? Well, yes it is, but don't get complacent. The data shows that nearly 60% of borrowers will renew their mortgage in 2025 and 2026. That's about 1.2 million mortgages alone and $300 billion of debt coming due. And get this, 85% of those mortgages were signed when rates were at an all-time low, with the Bank of Canada rate at 0.25 to 1%. This means that hundreds of thousands of Canadians will renew at a much higher rate than when they initially signed on. Now, if you ask me, no wonder people were panicking about an epidemic. But here's why simply shopping for the lowest rate isn't going to be enough. Monthly payments are going to jump regardless. Even with rates trending down, most mortgages will still see a payment increase. And according to CMHC and the Bank of Canada reports, nearly 60% of mortgages will see their payment increase substantially. Some homeowners could see their payment increase as much as 30 to 50%. Imagine paying $2,500 previously and now you're jumping to $3,500 a month. That's $1,000 extra a month. That $1,000 is devastating for a family that's already having a hard time affording groceries and gas prices. Good news is the worst case meltdown might not happen. The latest Bank of Canada Stability Report found that the payment increase that everyone was expecting is likely going to be less than what we initially expected a year ago. Most borrowers are actually positioned to handle this payment increase due to measures such as the stress test. In fact, 90% of homeowners will actually face a smaller payment increase than what they were initially stress tested for when they initially qualified. In plain English, if you qualified for a mortgage, you actually qualified to be able to pay that mortgage at a rate 2% higher than what you're actually getting. And this is to make sure that you have a budget that could handle a payment increase. And the Bank of Canada is saying essentially 90% of homeowners that are coming up for renewal in 2025 and 2026, that payment increase is still less than that stress-tested qualifying payment you initially had. But, and this is a big but, that is only true if everything else in your life stays stable. If anything's off, like job loss, more debt, or your spending gets out of control, these higher payments could spell trouble. So don't exhale yet. This epidemic might be over on a macro scale, but for your personal finances, they could still be at risk. So why am I telling you to prepare now, even though your renewal might be a year away? Well, it's because the landscape has changed. And waiting for that renewal letter in the mail, it might already be too late by then. We just talked about how there's going to be 1.2 million mortgages coming up for renewal in 2025 alone, which means lenders will be processing an unprecedented amount of mortgages at the same time. That wave alone can lead to delays and stiff competition between lenders. And more importantly, thousands of households will face payment shock. A Renewal EPIDEMIC survey found that 57% of people are expecting their mortgage payment to increase, and out of those people, a large portion are expecting it to increase significantly. Of those people, 81% are saying that it will strain their financial situation. Now just think about that for a second. 4 out of the 5 people will say that it's going to strain their financial situation. Many even fear that they're going to have to cut back on a lot of things or potentially even get a second job. Now, early preparation can help soften this blow for you. Now, this is through refinancing, restructuring, and budget adjustments before the crisis actually hits. I also want to touch on job risk and economic uncertainty, because the broader economy isn't exactly giving us a free pass. Job security is a real concern in 2025. In fact, CMHC forecasts that unemployment will rise throughout 2025 into early 2026. And on top of that, we're hearing about trade tensions with the US and Canada trade conflict just intensifying over time. This could also slow the economy and risk a mild recession. What does that mean for you? Well, it means potential job loss and reduced income, all at the time that your mortgage might be going up in price. Now, preparing for this early could mean a couple things. It could mean going into a mortgage product with more flexibility for when that time comes, or restructuring your mortgage so you have more monthly cash flow so you can start building up an emergency fund. Don't assume your paycheck will always be at the amount it's at right now. You always want to be hoping for the best, but preparing for the worst. This is exactly why we do have the stress test in Canada. We want to make sure that you can account for those payment increases. But even with that, there is still risk due to the fact that income levels might not always be the same. What I want to talk about is household debt and rising bills. Canadian households are among the most indebted in the entire world. Isn't that insane? And not only are we the most indebted, but that debt goes alongside with some of the highest living costs in the world. The average Canadian, excluding their mortgage, carries $21,000 of consumer debt. And this consumer debt is often charged at an interest rate of 20+% because it's oftentimes on credit cards, line of credits, and personal loans. If you are carrying a lot of debt, those higher mortgage payments that are going to come might be the tipping point for you. We also need to take into account inflation, because while things have cooled, they're still quite a bit higher than they were a few years ago. This is why an early renewal is so powerful, because we can look at restructuring some debt to increase that cash flow so you can build up that emergency fund. Or maybe you want to go into a mortgage product that is a lot more flexible. There are mortgage products out there where you can pay extra during the times that are good, and you are actually not required to pay when times are tough. This is all about getting your financial house in order so that way when this crisis does hit, you're in a good position to handle it. The last thing I want to talk about is tighter lending rules and credit scrutiny. Now, OSFI has actually introduced new guidelines that the banks must follow. For an example, as of 2025, banks now actually have a limit on how many mortgages they're allowed to offer above a certain debt-to-income ratio. This means mortgages that are actually 4.5 times the household income of the borrowers are now capped across all lenders. Now, if your income hasn't kept up and you've also taken on other debt, refinancing to increase your mortgage amount to potentially pay out that debt and put you in a better situation is only going to get harder to do. On top of that, the stress test is very well still here. And when you initially stress tested, you were going at your original rate plus 2%, which likely put you in the 4 to 5% qualifying rate range. Right now, you're essentially having to use a qualifying rate in the 6% range due to the rule of adding 2% to whatever rates are on the market. This means that if you switch lenders to try to borrow more to actually put yourself in a better situation by paying on your debts, you have to prove that you can actually handle those payments at a much higher rate than what you're getting. And ultimately, some people that might be able to afford their mortgage on paper might not actually qualify for the mortgage that they need. Lenders are also looking at credit history more closely. If you have missed some payments on other loans or types of credits, this could ruin your chances of renewing into a good product. Addressing your mortgage early can help you get ahead of some of these issues. Maybe you hold off on that big car purchase, or maybe you pay down some of your credit cards. That way, when the time does come for your renewal, you're already at a much higher credit score than you're at now. Now, in short, preparing early is going to give you an edge on what's to come. You can't control what happens with the economy, and you can't control what happens with the Bank of Canada. But what you can control is how ready you are. Don't wait till a month before renewal to start scrambling. Why not start 12 or even 18 months earlier? Because there might actually be a situation where you could renew early and save a lot of money. Knowledge and timing are power here. This is a lot to take in. There's economic factors, there's new rules, there's tough choices, and it's probably very overwhelming. Truth is, though, you don't have to navigate this alone. At Whiteridge Mortgage, which is my company here in BC, Canada, We're not just going to help you find the best rate. We're going to offer you one-on-one strategy session with our experts to help map out your situation for the next 12 to 18 months and try to figure out a way to put you in a better position. We'll analyze your income, your debts, and your home equity to help come up with a strategy that's going to work for you. Think of it as like a financial checkup for your mortgage. Whether you're worried about the stress test, or you're trying to see if it's a good idea to consolidate debt, or maybe you just want to know whether you should take fixed or variable, we got you covered. It's free, it's personalized, and you could save thousands, if not tens of thousands of dollars just by someone putting a little bit of strategy behind your mortgage. If you're interested in this, I am going to put a link in the description to book a call. Feel free to click that. We can set up a time to chat, see what your situation looks like, and then start coming up with a game plan. And with that being said, let's get back to the game plan. We've talked about some of the challenges that are upcoming. Well, now let's talk about some solutions. A lot of people, when their mortgage comes up for renewal, it's just about getting that offer in the mail, picking a product, and just signing whatever the bank offers them. That is a terrible idea, because this is the time where you have an opportunity to restructure things and really plan out the next couple of years in your life with absolutely zero penalty to do so. Let's go over some of the valuable but often overlooked things that can make a huge difference in your mortgage. These aren't going to be gimmicks. These are legit solutions for homeowners all across Canada that they can do with their mortgage. Re-amortizing is a great first option. Now, what this means is you could have an amortization of 25 years, or maybe you have 20 years. What you're going to want to consider doing is stretching that back out to 30 years. Why? Well, this is going to reduce your monthly payment quite significantly. And at the end of the day, what a lot of people don't understand is even if you took a 30-year mortgage, you can simply turn that 30-year mortgage back into a 20-year mortgage by increasing your monthly payment. But by taking the 30-year mortgage, you're getting the lowest minimum monthly payment that you can make in case times are tough. Now, I wouldn't recommend re-amortizing your mortgage if it's simply just to pay the lower amount and you have all the means to continue paying what you're currently paying. However, when used in a broader strategy where maybe we are increasing your payment, this can be a fantastic solution because it gives you that flexibility to knock off a couple $100 or potentially even $1,000 off your mortgage month to month if times are tough. The second thing would be adding a home equity line of credit. So a home equity line of credit is the same as any other line of credit, but it's attached to your home. So the limit's going to be quite a bit higher and the interest rate's going to be substantially lower than your standard line of credit. Now, this gives you the flexibility where you can access your equity if needed. This is great for consolidating debt. It's also great for investing. Now, we're not talking about investing in this video. We're talking about minimizing the crisis that could be ahead of us, but you could use it for investing in the future. Most commonly, it is going to be used for debt consolidation, and it can be a great way to have an emergency fund set aside because you'll always have access to that money. You are going to want to be cautious that the HELOC is going to be a variable rate, typically prime rate plus a half. So right now, based on May 2025, that HELOC rate would be 5.45. However, this is substantially lower than any other line of credit or credit card or personal loan you could get. Third thing would be a static payment option. Now, a lot of you think if you want to set payment, you have to go fixed rate. That is not true. There's a variable rate products that have a static payment, meaning the payment does not change whatsoever. That means you could take advantage of the upside of interest rates going down and you saving more money in interest. But then if interest rates were to increase, you don't have to worry about an increased payment. Now, it's very important you're working with a mortgage broker because a lot of banks, they don't give you the option between fixed variable and static variable. They either have a fixed and a static variable or they have a fixed and a normal variable. Therefore, you need to make sure you're going into a bank that has a static payment if that's something that you want. The way that this works is if interest rates go up, you're not paying any more towards your mortgage. You're just paying your mortgage down a little bit slower. It's increasing that amortization. If interest rates go down, vice versa, you're paying your mortgage off faster and you're decreasing that amortization. Now, this can be a great option not only for the static payment, but it also gives you the option to lock into a fixed rate whenever you want. You can essentially look at what that bank's offering for their fixed rates at the time you want to lock in, and that's what you would convert your variable into at absolutely zero penalty whatsoever. Another option would be a hybrid or a split mortgage. There are mortgage products where you can go fixed for a portion of your mortgage and variable for the other. Therefore, you can kind of segment what you want to be in a fixed rate, and then you can have a smaller amount that might be fluctuating over time. I don't typically recommend this as much, but it is an option that we can definitely discuss if it's something that you're open to. And there are also products like the Manulife One product that allow you to pay it down more when times are good, and when times are tough, as long as you have room in there, you can capitalize on those payments and actually not even make the payment. The interest will just add up over time. This can give a lot of flexibility to some people. It's very good for people that are in seasonal industries. Instead of having to save up a certain amount throughout the year to be able to cover those monthly payments, they just pay their mortgage a lot when they're in their good season, and then in their off season, they just don't make the payments towards their mortgage. Now, at this point, you might be thinking, okay, things are complex, but what's the bottom line for me? The bottom line is you want to prioritize clarity, long-term planning, and flexibility over just chasing that lowest interest rate. All about being adaptive. The world can change, your mortgage is going to change, your life is going to change as well, and you want to be able to adapt to things the best way possible. This might mean taking a mortgage with lump sum prepayment privileges in case you get an inheritance or a bonus at work to reduce your interest. Or maybe it means choosing a mortgage product with a more fair penalty calculation so you can get out of it early without facing a substantial penalty if you need to. It definitely doesn't mean committing to a mortgage that's a lot more restrictive just to get a 0.1% lower interest rate. That is the biggest trap people fall into. A lot of people don't even take the time to calculate how much that means on a monthly basis. They simply just see the lower interest rate and they think it's always better. That's so not true. You could be saving $15 a month for 5 years, and that's less than $450, yet you could be paying a $10,000 higher penalty if you needed to get out of that mortgage. I want to recap this video a little bit, so let's focus on the big ideas that we talked about. One is going to be, don't treat your renewal like a simple rate chase. Treat it like a full financial reset button. The interest rate is just one factor. You want to look at a broader economic standpoint, assess those risks, and leverage the right tools. That way, you can protect yourself in the event of a crisis and potentially even come out ahead. Now, like I already mentioned, Whiteridge Mortgage is here to help you every step of the way. If you guys do want to book a call, click the link in the description. Book a call there. You'll be talking directly with me. We can have a chat and come up with a strategy to handle this crisis that may be ahead and put yourself in a better position. Stay prepared, stay proactive, and remember that preparation is key, and using mortgage strategies can actually potentially put yourself ahead even through a financial crisis that we might be seeing in the near future. Thanks a lot for watching, guys. Click the button to subscribe. I'd really appreciate it. Like the video and ring the bell to be notified when other videos just like this come out. I hope to catch you on the next one.